And with that comes some significant changes of sorts, because I'll be honest, I'm of that age. And when I saw it, I was like, whoa.
Yeah.
Because I'm always looking for tax savings, and that was another way to do additional tax savings if you were able to max out a 401k and then do the catch up. It was like, all right, this is additional way to reduce our income and save taxes, but bye.
Right. So how the Roth works is that the Roth is after-tax money that goes in and grows tax-free. And so you have been all about the Roth. You wish that we had started the Roth when we could, the very first time that we could get into it.
I think the Roth was the greatest thing.
Welcome. This is For Better and Worth,
The podcast where we don't believe you have to sacrifice your relationship while you grow and build your net worth.
We are your hosts.
I'm Chris.
And I'm Ericka Young, and we're so glad you're joining us today.
All right, y'all, let's get into it.
Hey, babe, how are you?
I'm doing great. New year, new me.
I know. Wait, what's going to be new about you? I got to make sure I'm ready.
You know, everything.
No.
Well, not everything.
I need you to, some parts of you I need to stay the same.
A lot is going to stay the same. I'm just, Happy New Year to everyone who's
Happy New Year, yes.
So, you go into the new year with excitement and ready to, kick things off. And I'm ready to kick things off.
Yeah, I'm excited. I'm always thankful for a new year. I still have to call my aunt, who is 103.
Yes.
Because
we haven't talked to her.
It's been a couple months since I talked to her, and it's time to talk to my aunt. She has made it another year, and I just feel like there's something real significant about that. So,
she is 103, so
It's
like, shout out to you, Aunt Betty.
Yes, Aunt Betty. So, Aunt Betty has seen quite a lot of changes in the way that we navigate money. How about that? We'll start with that, right? And some things have already begun to change with the way that people get to save money. Back in her day, let's talk about her for a hot second. They didn't even have 401ks when she was born. So, we're gonna talk about some changes that are going on.
I think people should almost expect that things are gonna change from year to year.
Yeah.
Because the tax code, there's always some new tax law or something that comes into effect. And so I actually told you about this change when I first saw it.
You did.
And it is the changes to catch up retirement savings. Mm-hmm. And going into 2026, so if people aren't aware, the government has put a law or a change in place that if you are an income earner making over $150,000.
145 to be specific. Yep.
I thought it was 150, but
whatever the case.
Yeah. 145, 150. If you make more than that and you are over the age of 50.
Yeah.
And you're doing the catch up for your 401k savings, the change is that now you will actually have to put that into a Roth 401k versus your traditional 401k.
Yeah.
And with that comes some significant changes of sorts, because I'll be honest, I'm of that age. And when I saw it, I was like, whoa.
Yeah.
Because I'm always looking for tax savings, and that was another way to do additional tax savings if you were able to max out a 401k and then do the catch up. It was like, all right, this is additional way to reduce our income and save taxes, but bye.
Right. So how the Roth works is that the Roth is after-tax money that goes in and grows tax-free. And so you have been all about the Roth. You wish that we had started the Roth when we could, the very first time that we could get into it.
I think the Roth was the greatest thing created.
But we're still paying taxes. So it's just that we're paying it now and the growth is tax-free. So if we have to do a Roth now, versus putting it into the 401k, which is tax deferred, or I should say the pre-tax version, then on $8,000 in 2026, excuse me, I had a tickle in my throat. But if you are, paying taxes on that now, $8,000, if your tax bracket is 25%, if your effective tax rate, you're gonna pay $2,000 more in taxes. And people don't like that.
Yeah. And I think if you go back to the basics, like we encourage people to, max out your 401ks and that's if you are at an employer that has a 401k with a match. Go there first. Mm-hmm. Take the free money, max it out if possible, and then go to a Roth until your income reaches a point where you can't contribute. But if you don't have if you're at an employer that doesn't have a 401k, we would naturally say, which I think most advisors would say, go to the Roth first.
Right.
And put money there because that money grows tax free. And so you get a bigger amount of money tax free in the future, then go to a 401k.
Yeah.
But with this change, it's like, okay, you have to really start to consider.
Yeah. So here's my thing is that the government clearly wants their money now. They're like, we're not giving you all the opportunities that you can to save your taxes today. They're like, we need revenue right now. So think about that. If you and I are going to be...
I'm not surprised.
Right. If you and I are going to be paying $2,000 more in taxes right now, times however many over 50-year-olds who have $145,000 of income, FICA wages, then think about how much more revenue that is for them. And so...
I feel like the government needs that money right now because we are in a tremendous deficit. So they're looking for ways
this ain't gonna fix the deficit.
I know it's not.
This ain't gonna fix the deficit.
They're like, how do we get any revenue streams today?
Yeah. So I think the challenge that we face is that it's gonna always be a battle to save taxes. We're gonna always be trying to find ways to save taxes. We don't want to give the government more money than is necessary. But we still believe wholeheartedly in the Roth IRA. Like we still fully think that the Roth IRA is the way to go and to max it out. And here's what's interesting. It has only been since 1978 that we've had 401ks. So it's been not even, 50 years that we have actually had the 401k. And now, what I'm seeing in terms of a trend, what people are saying, some of the financial advisors and tax professionals are actually saying is that we're going to be moving more to the Roth, like more contributions to the Roth IRA so that you can get your taxes, your money taxed now before you let it grow. So I think that's interesting.
Okay, so I don't know. I have a lot of thoughts on this.
What are your thoughts, babe?
And I think when you consider like the baby boomer generation, they were the last generation to really get pensions.
Yeah.
And so they knew go to work, spend time at an employer, retire, get a pension. And it was really, us, the Generation X, that was like, okay, pensions aren't really an option in our generation once we became adults. It was like the 401k.
You got a little pension, or you have a little pension coming to you.
I mean, I worked, but I worked for an employer where I had some pension built up, but they gave me a lump sum buyout, which I rolled over.
And I had a lump sum buyout as well when I was working in corporate America, and I rolled that over as well.
And so I think, people of our age who've been working and saving, and you have come through the phase where your early career, we're more mid-career, or even further in mid-career. I hate to say that, like that sounds so crazy.
Listen, I'm gonna let you speak for yourself, okay?
That sounds crazy.
I'm gonna let you speak for yourself.
But I'm gonna say mid-career, where you're still in that accumulation phase and you're saving because you still have time to work.
Yeah.
And so 401ks were just a really good way to build that savings. But as you get older and your income increases, you become focused on tax reduction.
Yeah.
And this was a good way. Well, it's twofold. I say it was good because one, it allowed you to save more beyond the the 401k limit.
You talking about the catch-up contribution after age 50?
Yes, the catch-up contribution allowed you to save more,
right,
to be a little more aggressive towards your retirement goal.
Yes.
And if you're in that position and financially you could afford to do it, highly recommended. And that also reduced taxes. So to me, it was like, bam, this is a twofold. It's a win-win because now I'm saving more for retirement.
Right.
And I'm reducing my taxes at the same time. I'm like winning. But the whole time, I've always thought like, okay, now you got this big tax deferred asset in a 401k. It's like, okay, well, I'm hoping that in the future, it's almost like you're hedging your bets. Like in the future, my tax rate should be lower. So when I actually do pay taxes on it, I'm at a lower tax rate. So the tax implication is smaller. But I'm a huge fan of Roth IRAs because though you pay taxes on it today, those small portions of investment that you put into a Roth, because the Roth limit is
for 2026, the Roth limit is $8,000.
So $8,000 broken out over the year, you pay taxes on it. It's a smaller implication per se. But you do that for 10, 15 years and all that growth, you contribute and the growth is all tax free. It's like, okay, I'm loving that as well, because a good strategy consists of tax deferred plus tax free, because then they offset when you reach the age of minimum, distributions and minimum required distributions and things like that. So I've always liked that plan.
The thing about the Roth, though, that we need to be clear on is that it is less that you can put into it. It's about 25%. So the 401k. The 401k limit for 2026, is $24,500, and then the Roth limit.
We did that in unison.
Look at us. Come on now. And then the Roth is $8,000. So they don't want our tax-free growth to be on $24,000. They like, no. Yeah. We want to get our taxes, and so they're limiting how much we can put in that so that it's not all tax-free growth, right?
And that's been from the onset with Roths.
It has.
If you allow people to put as much into a Roth as they could into a 401k, the government's like, well, when do I get paid?
Yeah.
And get paid for 40 or 50 years until you retire.
Right. And the other thing, and I had a client, I only keep a couple clients, and this is why I do keep a few clients so I can stay in the pulse of what's going on with people. But a question that came up with one of my clients was, I want to understand, how do you make decisions at retirement? Because she's pretty close to retirement. I'm going to say she's within 5 years of making that choice. She can make it now if she wanted to, but she really wants to save more money. And in her case, she was like, so how do I determine, how much to pull out of the 401k? And her concern was being taxed on a certain amount. I said, listen, if all you need in one retirement year is $30,000 from your 401k monies, and you're not required to do the minimum required distribution, then take out the $30,000 and you're only taxed on $30,000. Yeah. Like, you're only taxed on the amount of income you have in that year.
Take out what you need.
Take out what you need. Don't take out $100,000 just because it's there, and because you're gonna be in higher tax brackets. Yeah. So just you that's why you have to be very intimate and close to your budget. And so there's this dance that you can do. If you have both a 401k or amassed some wealth in a 401k, as well as in a Roth IRA, you can do this dance of, I'm gonna take $30,000 from my 401k dollars, and then I'm gonna take $10,000 from my Roth IRA because I'm not gonna be taxed on it. And that being able to go back and forth and have a variety of options and strategize is huge. It'll save you taxes down the line. And also it just gives you a variety of ways to maneuver. The other thing I'll say is, in the almost 50 years that we have had 401ks, the reason why one of the reasons, let's put it this way, why 401ks became into existence, and this is our generation predominantly has been affected in that transition. Let's say all generations after us are definitely going to have to take it into their own hands. But previously, you know, the government would take care of people in terms of Social Security. People could lean on Social Security. They could also lean on pension plans. And when the pension plans began,
those are two unknowns now.
Yeah, well, you can't depend on them, right?
Yeah.
And so the pension plans slowly started going away, but the responsibility of your own financial future became more into your hands with the 401k, because honestly, you could do it or not do it. A pension, they were required. You know what I'm saying? Like it was kind of expected that your company would offer to it unless you were a small company, right? And so now it's in our hands. We have to get educated. We have to know what we're doing. We have to know how to talk to the plan administrator or a financial advisor or whatever to know what's really happening with our money. And that there was this time period where folks were resistant. They didn't understand it. They didn't trust these advisors. They weren't certain what's going to happen with their money. And we've had to get beyond that, educate ourselves, and jump in with 2 feet and really, learn how to manage our own funds. And now I think, in addition to that, with this 401k, with this Roth IRA change, we're going to have to actually take our tax knowledge more into our hands as well, so that we can be strategic when we're talking about our retirement planning.
I think after the initial shock, I was like, oh man, this isn't right. But I've settled in on it. And I recognize the fact that, one, it's a blessing if you're able to, contribute, max out the 401k and max out the Roth contribution to catch up. That's a great thing to be able to do. But I was actually having a conversation. We were having a conversation and we talked about this with one of the financial professionals that we deal with. And they were saying, because I was thinking about doing a backdoor Roth. And I was like, well, man, I feel like we need to start doing that. And so in essence, this has forced my hand a bit to do a backdoor Roth anyway. And now I actually called my plan administrator and had a very good conversation to really get into the details and the nooks and crannies of it, because the good thing about it is now employers, I think we talked about it in 70%. I think you said 70% of employers have 401k plans available.
Yep.
And so that's great, right? And those others that don't have 401k plans, I think employees they have to do like you said, they have to be aware of their financial plan and how they're going to maneuver. And so I actually called my administrator before the beginning of 2026, and the option was not even available for me to do the traditional catch-up contribution as I did in previous years.
Yeah.
They already removed it.
Yeah, good.
And so they were already ahead of the curve, because I went in and I made the election to do after-tax Roth catch-up. And that was the only option that was available. And I was like, wow, they were already
ready
on it. And so in essence, considering doing that backdoor Roth conversion, I've already done it and I know that there's benefit in that, because I look at the time to continue working. And I've always wanted to do more into a Roth, but our income reached a point where we surpassed the eligibility to be able to contribute. So I was like, man, I wish in the early days, we're trying to get out of debt. We're trying to raise kids. We're trying to buy homes, and we couldn't do all of that, just being honest. And so we didn't have as much time to contribute to a Roth before our income exceeded the eligibility. So I always felt like, man, we missed out on that opportunity. But now the opportunity presents itself again, and we can do the backdoor. And when I looked and I talked to my
it's not
planner,
backdoor. It's just through your employer.
It's not backdoor.
It's just through your employer.
You're right.
And so that's a benefit, because not everybody has that. You know what I mean?
It is. And I was asking a lot of questions, and I saw that within, and I'm assuming that this will be the way for a lot of people who are watching and listening to this. Within your 401k, if you go and you look at the breakdown and the distribution of that 401k, there is a Roth component that is listed. And when I broke mine down and looked at it, I was like, oh, I already had money in the Roth portion of my 401k because clearly I had done some after-tax Roth contributions previously. And so now that portion, they're monitoring that portion of it, and it will be within your overall 401k portfolio. And once you reach 59 and a half, you can call your administrator and ask them to separate it. So then you can see the traditional 401k portion and you can see the Roth portion of it. Because you could choose, like any other Roth, you could choose which portion you want to draw down on. And so it's just an interesting thing. And so it's kind of I think it is kind of a silver lining in a sense.
It can be. So here's the challenge. It's a silver lining for those who have the Roth IRA available to them within their 401k. For those who are over 50 and their income is over 145,000 FICA wages, then and they don't have the Roth option at work within a 401k, there is a possibility they will not be able to do the catch-up portion. And that's the challenge.
Yeah.
And so that's why you have to talk with your plan administrator to see.
Then, if you're under $145,000,
you can still
do
the
traditional.
You can do
catch-up.
whatever you were doing previously. If if you are over 50 and your income is under 145,000,
it's business as usual.
Nothing changes for you. But if your employer does not have the Roth IRA option in the 401k, and you do qualify on both the income as well as on the age, that's you need to make sure that you
got to ask some questions.
You need to ask questions, but also
make some noise.
Well, you're right, because if you do have a 401k, you likely want to ensure that there's 10% of companies who have 401k who don't have a Roth IRA. You need to raise some cane so that they will get the Roth IRA.
Because I don't want to miss out on that option.
Right. And
because the government made a change. Yeah,
it costs something. And it is the plan administrator that needs to make sure that is available. And if the employees are raising enough, concern, then hopefully they will do that. But there's going to be a segment of the population for whom they may not be able to do the catch up. And so what I would say is make sure that you engage with a financial advisor outside of a work plan and make sure that you know all of your options available to you for investing for your future. And we're talking about the tax favored accounts, but you can invest in other ways that are not tax favored. It's not to say that you can't invest for your future. You totally can. It's just that you're not going to be necessarily doing it in tax favored accounts.
I think there's a lot of silver linings to this. Like we think about, tax-free withdrawals at retirement from a Roth account, which is great. The interest, the compounded interest that grows, all of that, it's all tax-free. So when you take money out, it's like you don't have to worry about taxes because they've already been paid.
And you have no required minimum distributions on a Roth IRA.
Which is awesome.
Amazing. We'll take that.
Because you can wait to take that money until you need to take that money. And I plan to live. I don't think I'm gonna be waiting. I think I'm gonna be taking money out and just living my life.
Oh my gosh. But and here's the thing. You say that, but honestly, you do have to balance it because
the money has to last.
Let's go back to Aunt Betty.
The money has to last.
Let's go back to Aunt Betty.
Yeah.
She is 103 years old and she has lived longer past her retirement now than her working years, or she's right there. Like even if she worked 40 years, she has lived 40 years beyond the time that she retired.
She's still living off investments that they made.
You don't know. And sure, she lives with her daughters and all of that. So her expenses, her medical expenses probably, taking care of her medically is probably a little bit more. But I'm Betty getting around. But think about it, like, if your money has to last you 40 years of not working, that's a long time. Like that creates strategy.
I get it. I think I think there's a lot of silver linings, which I just want to pull those out because, what if taxes go up in the future? You actually make yourself exempt from any future taxes when you talk about the Roth, no matter what the tax rate is or what it goes to, the Roth portion, you're tax free. And your 401k, those traditional 401k or traditional IRAs, they are still going to be taxed at whatever tax rate you're at in the future. So I think this, I'm trying to look at the upsides.
There is upside.
There are definitely upsides of it. It's just, I think even myself, I had to change the way I looked at it because at first glance, I was like, whoa, wait a minute. And I had to peel the layers back and really start to understand it. And once I peeled those layers back and understood it, I was like, okay, let me look at the pros and the cons of all of this. And though there were pros, there were also cons. But I think at the end of the day, for me, they kind of balance out a bit. And it doesn't matter because I can't change it.
I know, right? That's the other thing is we can't do nothing about it. But
it's like, what you gonna do?
But the other thing is, if your company did not make that change easy or automatic like your company did, because you work for a large company, right? And so if they didn't make it easy like your company did and made it automatic, you need to ensure that you make the change within your 401k options because there are penalties.
And it was accidental. I'm gonna let you come back to the penalties, but it was accidental. You know why? Because I was cleaning my email out and I saw an email from like the plan administrator. I was like, wait a minute, it said confirm your catch up contribution because they were changing it. They had removed the percent that I put in there and made it 0. And so I was like, wait, what is this? Then I started reading and checking. And had I not been paying attention, it could have slipped through the cracks and we could be in 2026 and I'd be like, wait a minute. I set this up to happen and it's not occurring. So then I went and made sure I set all the levers and everything was in place. But you were talking about the penalties. Come back to that.
Yeah, so frankly, if you don't adhere to the way that the law is designed, there are penalties to that. And so if you go the entire year and haven't made those changes that are necessary in order for the dollars to be going to a Roth IRA, penalties means more taxes, period. I mean, you know what I'm saying? A penalty fee is a tax on that money. So you have to make sure that you are on top of it and you'll have to likely move the money. So if you actually put it into your 401k and didn't change anything, you'll have to move the money to the Roth and pay the taxes in addition to potentially a penalty.
Or you're going to have to do a return of excess.
Yeah, we're not trying to do all that. That just makes it harder. So it's best if you make the change when you need to make the change. And so I know we're doing this at the top of 2026, this episode, but it bears to reason that you need to go ensure that your dollars are going where they need to go. If this does not apply to you, that's fine. Just know that this is the direction that things are going. And so if in 5 years you realize, I'm going to get a tax, I'll be able to actually do the catch up. Just know that this is going to be a Roth option and there are income limitations on how that's done. Things can change over time, but you just want to make sure that you're on top of it.
And I think that even if you're someone who this doesn't affect you today, you should be on notice. You should be paying attention because things change almost every year.
Yeah.
And so you've got to be aware and pay attention to the changes because if you don't, they can catch you off guard. And if you get caught off guard, you won't be sitting here talking about the pros and cons. You'll be scrambling, trying to figure out what to do. And that's a position. I just don't like to be in that position where I'm caught off guard because I'd rather be able to make decisions from a point of a position of power. And I say a position of power, meaning that I'm informed, I'm aware, I've broken it out, I've thought about it, and then I can make a more informed decision. And so I think that people have to just be aware of what's going on. And we didn't go through all the cons because I think people can figure out the cons. You don't get the immediate tax break any longer with that $8,000 portion of the catch up because it's going in the Roth. And, it's going to cost you something up front because you're going to pay taxes up front. And like you said, that on $8,000, that's about $2,000 in tax liability. So one thing that I want to do that I think is important, I want to share that since this does affect how much you pay in taxes, you're going to need to make certain that enough is being taken out. So in our case, I mean, that's the truth, right? In our case, if
it's a 25% more in taxes, and that's $2,000 a year. That's $166 more per month to be paid in taxes. And if you typically break even or you owe taxes,
you need to say take out an extra $166 a month.
Yep. So just make sure that you are paying attention to that part of it, because I think that no matter what the tax difference is on any different tax changes, you need to know how that's going to affect you. Yes. And there are ways. I like to use the withholding calculator on the tax website, on the IRS website rather, and you can project what these things are. If you work with a professional, a CPA, they can help you to figure that out as well. And you might be able to talk to someone in payroll at your company, but don't think that not doing something about this in January or February means that it's going to be fine if I wait until December. It won't be. You will not be satisfied and happy with having waited on making these changes for your tax implications.
I'll say this to anyone who is 49 and they're turning 50 this year. You have to be aware of this because you can start doing this catch up now. Mm-hmm. It's the year you turn 50. So if you're 49 and you're turning 50 this year, you can do the catch up all year long. So you can't ignore it because it's a great option to explore. Mm-hmm. And, you just got to be informed. And, but what would you say is your make it worth it for this today?
Gosh.
There's a lot to unpack here.
Well, I'm going to say that when things change, you need to know what they are. So I appreciated that you brought it to my attention because I didn't know prior to you sending that email to me. And then you and I did some research and then you figured out how it mattered to you. As a self-employed person, I do my, investing for retirement differently. I'm not, frankly, I don't have the option to be able to do it the way that you have, right? But I do a SEP IRA, and so
those have different limitations, and so you can put even more into a SEP. Mm-hmm, so
you can. But we needed to still be informed, even though you were the only person for whom that this mattered, and so I just wanted to make sure that
in this scenario, it mattered for me because it was impacting me, but it matters to a bunch of people.
Oh, I'm talking about when I know
between the two of us.
Yes, when we're talking about, the changes that happen in taxes, you got to figure out how it matters to you. You know what I mean? So just be informed and be on top of your own
girl,
game.
This matter to you too. We paying more. We paying more in taxes.
We are, unfortunately.
Can I hold 2,000?
You're the one.
Can I hold that?
Listen,
extra 2K?
Get out of here.
Let me hold something.
Anyway, what is your make it worth it, crazy?
I just say be aware, be informed. Don't get caught, off guard. I think it's easy to discard emails when you get them. Oh, that's nothing. Just delete. You got to know what's going on. And sometimes it's not just, from an email. It's like, seek out knowledge, have different news sources, be aware of what's changing, in your financial future or just in life in general, because I think sometimes we can go through life with our head down and not paying attention, especially in this cell phone generation. So many people are just always, head down. It's like, sometimes you got to look up, look around and see what's going on so that when changes occur, you know how to respond to them.
And the other thing that I would say too is for those who aren't in the place where you're maxing out your 401k option, which is the $24,500, and obviously you haven't gotten to the catch-up portion either, because you got to do one before the other. You have to max out the 401k in order to even take advantage of this catch-up portion. The point is, someone over 50 can now contribute $32,500 in 2026 towards their retirement future. And if you're not there yet, the one thing that I want to say is this can be aspirational for you, right? So So maybe you want to get to a point where you have enough income to be able to take advantage of these types of things, right? Maybe you want, there's this motivation to, when you hit 50, like you can max out everything. Maybe it is paying off your debt in order to be able to afford to do this on a monthly basis, right? Like,
these are good problems.
Right. My hope is that you see this as, I can't wait to be able to take part in this, no matter what the government does to tax me in this situation, because what this does is it changes your outlook on your own financial future. You're not dependent. One, you're not dependent on the government. You're not dependent on Social Security. You're not dependent on a company for pension. This is what financial independence eventually looks like, is being able to change.
This is you taking control.
Yes, and change your own future because you decided that saving for your future is of high priority. And so I just want, for those of you who aren't quite there yet, think about every year how you can stair-step your way up to being able to max out the full amount that you can do, and then eventually also the catch-up portion as well.
I mean, I love that comment, because I think I don't want someone to watch this video or listen to this podcast and not think, or think that, oh, that's not me. It's like, you need to be aware, because I believe that when people work hard and strive to get to that next level, it will impact you. And I like how you said, make it aspirational, you know, because I mean, 24,500 is a lot for a lot of people to
it's $2,000 a month.
That's a lot.
Yeah.
You know? But I think when you live your life in such a way where you put your priorities in place first, you know, you can say, okay, I'm going to live off 60, 70% of my income because I've reduced debt, and I'm going to set these other priorities, be it retirement and savings and things like that. Then you can do those things. So there's possibilities and there's options, but this was a good conversation. So
yeah. Exciting. So I'm glad that you thought of it and brought it up, and it made us go deeper, and then hopefully folks will make the adjustments.
People what they want and need.
Listen, you were ready. When you heard about this, she was like, hold on. How does this affect me? And that's how I hope that our listeners are as well. So anyway, this has been good, honey.
Yeah. So until next time,
we're out.
Thank you for spending some of your time with us today.
We appreciate all of your support, so be sure to subscribe, rate, and review us wherever you listen to this podcast.
You can find us on Instagram at For Better and Worth.
And sign up to receive our free guide, The 7 Reasons Your Money Relationship Isn't Working with Your Partner, on ForBetterandWorth.com.
Until next time, we're out of here.